with you kind of the 8 non-negotiables that I use to really, this is essentially how I look at commercial real estate. And I get a lot of questions about how do I make investing decisions. And I thought what I would do is just kind of share with you, this is my 8 non-negotiables, and I'll run through them here right now. Okay. So, let's just see. Okay, there we go. So number one is the deal big enough? And really what I'm talking about here is, the way I look at it is commercial real estate investing in general takes time. And so I would much rather focus my energy on a deal that's going to be big enough with enough upside, right, to justify the amount of time and energy that I'm going to put into it. So to do a $1 million deal doesn't take, or a $10 million deal, like the amount of effort and energy to either raise the money, get the debt, find my partners, find the property. It's not like it takes 10 times more energy to do a $10 million deal, which is why, frankly, for me, my sweet spot is in that 5 to 15 million. Now, I've been at this for 12 years, so you can just adjust based on what you're comfortable with. I mean, if it's your first property, it might be 1 million, 2 million, whatever it happens to be. Okay, and I'll kind of give you a quick story here. So we purchased a property, trying to think, probably in 2011, I think is when we bought the Muskoka 2 resorts out there. And it was big. I mean, it was 1,152 acres. One was 1,100, the other one was 52. And so it certainly hit the big enough, right? I mean, it was a very big development, almost too big for our first resort development. And the upside was certainly there. I mean, at the end, we took, it was $8.5 million was the purchase price. We took it to 17 million, was when we sold it 3.5 years later. But the location and where it was, well, I'm going to tell you about that here in non-negotiable number 2. Okay, so what I look for is a desirable location, because I can tell you that if you're new to commercial real estate, you don't want to be the bigger fool. I will tell you, having worked as a commercial agent and seeing many rookie investors after they bought something and then they call on me and say, Shane, can you sell my property? And I realize that when they bought the property, they were probably the bigger fool. They bought a deal that no one else wanted and they overpaid. And so unfortunately, in those situations, you're either stuck with it until the market gets back to a cycle where people are ignoring basic fundamentals of commercial real estate, and then you can sell to another fool. But that is not a strategy that I recommend. So just a very, I don't know. I mean, when it comes to, say, retail, office, and multifamily, following the smart money, looking for, say, a Starbucks or Whole Foods or Safeway, I mean, that's going to give you an idea. Generally speaking, these companies are very sophisticated. They have a lot of people on their team, and so they know where the best locations are. So that is kind of what I would say in terms of following the smart money. If you're new to commercial real estate, that's a quick, I hate using the word hack, but I mean, it'll give you some perspective. Back to Muskoka. So these properties were in desirable locations. One surrounded a 200-acre lake. The other one was right on the Trent Severn, which is it's a very popular waterway. So in terms of location, it was fabulous. The challenge, and this is where I think some people get hung up. I mean, I'm just talking about from my own perspective and what I've seen others do, so you can kind of take it and apply it to your own situation. But I lived in Calgary, and Muskoka is 2 hours north of Toronto. So it's a 4-hour flight plus a 2-hour drive. So minimum 6 hours. So if there's ever an issue with that property, which there was, and let's say I'm on vacation, or let's say something comes up, I need to basically get on a flight, 4 hours. So really it's like 6 by the time you drive to the airport, check in, and then get there, get my rental car and go up. It's a full day both ways. And really, I mean, this deal was big enough that I was focused on it 100%, but it was still challenging, especially when I had, at the time, I only had 2 kids, but, it wasn't ideal. Now, here's the other challenge that I think people will not talk about. When you go into small communities, it is very difficult to find quality talent. And what I mean by that is you need property managers. In our situation, we needed salespeople, we needed development experience. And in these smaller towns, it's just, there might only be one or two people that have the skill set to be able to do it. And so in that situation, you're often, I don't want to say held hostage, but you don't have nearly as much leverage because you're really, um, um, you're reliant on that one person. And you know that if you don't have that one planner, that one property manager, that one resort salesperson, whatever it happens to be, it might be 6 months before you find someone else. So just keep that in mind in terms of location and the size of the city that you're investing in. Number three is, do you understand, or do I understand the deal? And really what I mean in this non-negotiable is, does the property fit my core competency? So I've found that because I talk about industrial, multifamily, retail, mobile homes, I've been at this for 12 years. I've been a lender. I've been a developer. I am a developer right now. I'm an investor. I've been a commercial real estate agent, both on the leasing and investment sales. So I've got a broad background. And I think when people hear, oh, retail, I would love to do retail, or industrial, or mobile home, that sounds great. What I would suggest is, if you're just new, pick one, focus on it. Now, usually what happens is new investors into commercial real estate, from what I've seen, they generally gravitate to multifamily, and there's nothing wrong with that. I think because it's probably the easiest to understand. Usually people have bought and sold residential houses, rentals, flips, whatever. So it's not that much of a jump to go from leasing, say, a residential house to leasing an apartment building. Now, there's major differences in terms of how do you property manage it, how do you fill it, how do you finance it. However, understanding the tenants in terms of who's there is not as there's not a big discrepancy, if you will. When you get into industrial or retail, certainly understanding who your tenants are is much different, which is why generally the clients that I work with, if they let's say it's a business owner that owns or maybe leases an industrial space or leases retail space, they have some context for the leases. And so what I would say is that if you have that experience, then you can use that to determine whether or not you want to get into a different asset class outside of multifamily. So back to Muskoka, we purchased these two resorts believing they were the same as mobile homes, and they weren't. They were way more complicated, and it actually turned out to be almost like three businesses in one. So one, it was a residential development with about 1,186 lots. It was similar to a hotel where we had like weekly and nightly leasing. So we needed a team for that. And then it was, I guess I would compare it almost to timeshares, although we weren't selling timeshares, but we had a big sales team that was selling our cottages, or like a home builder, if you will. And so when you merge all three of those together, very complicated. And frankly, I didn't have the core competency when I started, but when you're in the deal, you have no choice. So we figured it out very quickly, but I can tell you it took longer and it was a little more expensive than had I come in with that background. So just to kind of, I guess, be mindful of that. Okay. So number 4 is functional. Is the property obsolete? And if it is, then am I purchasing it for land value? And some of the things that you would look for would be, does it have enough parking? What's the ceiling height? Specifically in all asset classes, but I would say in industrial, certainly. And then also in multifamily, what's the configuration, right? How are the buildings laid out on a property? I was in Phoenix recently, and this retail property, the configuration was essentially obsolete. And so I looked at it and said, am I buying it for land value? The answer was no. And so I had to pass on the deal, even though the price per foot was very good. Quick example. So when I was selling commercial real estate, there was an owner of an office building here in Calgary. It was in a good location, not great, but it was good. And when he bought it probably at the peak of the market, when vacancy in office buildings was probably like 3 or 4%. And the challenge was it didn't have enough parking. And so when the market turned and it got a little soft, very difficult to lease out. And when the owner approached my partner and I, back when I was selling, like I said, commercial real estate, I estimated, based on his debt and the amount of vacancy he had in that property, that he was burning minimum $20,000 a month just to keep the building afloat. So I can tell you that when you have an obsolete building, and the challenge was for him to sell it, he was probably going to have to take a $2 to $3 million write down which I don't know if he would have been able to absorb. So just really, I mean, it's so key to have someone else look at your deals to make sure you're not buying an obsolete building. Number 5, cash flow today. I mean, this is very, I guess, self-explanatory, but I'm going to just tell you a little bit about how I look at it. So number 1 is I don't pay for future value. 95% of the time, right? I mean, sometimes, yes, I'm going to probably, just depending. I mean, if the property is distressed, 40% vacant, then likely you're going to have to give some value. You're buying on a price per pound. You're not buying it on cash flow. But I would say the majority of people that are investing in commercial real estate focus on cash flow today. You don't need to really focus on distressed assets if you're new to it. Sellers will generally try to get that upside baked into the purchase price. And it's your job to explain to them that if it was so easy, then they should do it. And then you will cap it, or you'll assess the value based on the new cash flow. I mean, that's generally how I purchase commercial real estate. Okay. Now, these non-negotiables, there's always nuances. There's always circumstances that may be outside of the, that there would be like a one-off situation or unique situation. These are best practices for me. Okay. And so you can decide whether or not they work for you. Next is just kind of a quick story. So this is it was a mixed use multifamily. It was about $13 million plus or minus, excuse me. And it had ground floor retail, 2 floors of office, and then it had 5 or 6 floors of multifamily up above it. The 2 floors of office I was going to convert from office to multi, but the challenge was the purchase price I needed. I wasn't able to bridge the gap with the vendor, and the reason for that was he wanted a price that essentially meant if the stars align. This is what I always say. I'm like, if the stars align and everything works out perfectly, I'll make a little bit of money. But if there's any screw ups, and when you're taking, say, office and converting it, I mean, very difficult to have like a super tight budget, because there's going to be change orders. There's going to be unknowns that come up with code and just timelines and costs. So unfortunately, I wasn't able to bridge the gap. And far as I know, that property is still listed for sale, because I don't think many people are going to be able to accept the risk for the return. Number 6, buying below replacement value. Certainly self-explanatory. I mean, you're buying a property below what it would cost to build new. Now, this is a rule that I will bend, and it's because I do developments. And really the way that I look at it is, if I'm buying in so I guess there's 2 ways that this rule could be bent. Number 1, am I buying a property in a location that can't be replaced? So that's number 1. And number 2, when I'm doing a development, generally speaking, I'm buying land, I'm upzoning it, meaning I'm adding value, and then I'm building a brand new property. And that new property is going to be essentially the same price that a 10 to 30 to 40-year-old property would trade at. And so for me, I feel like there's less risk to have a brand new building at the same price as I could buy a 25-year-old building. So that's just how I look at buying below replacement. But let's say you're buying a multifamily that's 1982 or 2000. You want to make sure there's a delta between that and a brand new property, at least in my perspective, unless you're buying in a location that is just so unique. Number 7 is leverage. And really what I'm talking about here is, can I put the right debt on? Sometimes you're assuming someone else's debt, which might be inferior, in which case you want to know, can I top up the loan? Can I put a supplemental on? Is there a buyout or a prepayment or a defeasance? These are the type of questions you want to ask and talk to the lender on. A quick example of an apartment that I helped clients sell, 240 units in Dallas. They put 10-year debt on it when they bought the property because they had a long-term vision for the property. When they went to sell, I believe the prepayment was in the $2.7 million range. And the reason for that was interest rates had fallen significantly. And so the lender at the time was getting a much higher rate than if they were to get back that, say, $20 million and lend it out at 3% versus the 5%. I mean, those aren't the numbers, but you just get an example, just get the idea. So what I would suggest is, if you are buying multifamily or any commercial property for that matter, just understand the debt very closely, and have a plan. How long do you plan to hold it? Because if you plan to sell it in 3 years, putting 10-year money on it may not be the best idea. And this is really where a commercial broker, commercial lender, uh, commercial mortgage broker can really help you. So spend the money. If you're not familiar with commercial debt, I would say certainly hire a commercial broker. Number 8 is control. And this is, so for me, I always want to control the deal. So if I'm raising money, I want to control the decision making. And some of the risks I would say are, number 1, land lease. You don't fully control it. Partners, who makes the decisions? You know, the more partners you have, the less control you have. Lender, what do they need to see in terms of that partnership agreement? And title, what's registered on title? Because this is going to impact your level of control. Single tenant building. So this quick story, I was chatting with a gentleman who was looking to buy a single tenant industrial property. He was looking to raise all the money from others. Essentially, wasn't going to put any money into the deal. And the way that he was talking about structuring the deal, mainly with debt versus equity, was going to put him in a very vulnerable situation if things didn't work out. And so without getting into details, because I want to be, I mean, this gentleman, obviously he paid for the consult. I don't want to give away, sensitive information, but we discussed a different way to structure his deal so that he wasn't going to be as vulnerable, number 1, and question whether or not he should even go into the deal based on where we are in the market cycle. So I just want to leave you with kind of a final thought, and that is, the game of investing in commercial real estate. I call it a game because there's players, there's properties, and the reality is, if you're new to the game and you don't have an advocate or a mentor, I believe that you're putting yourself at a bit of a disadvantage. So for me, I was very fortunate. I've had many mentors. My father-in-law, I mean, his family company's been in business for 96 years, publicly traded. They have a REIT development company. I mean, he's guided me and really helped me avoid a lot of expensive mistakes. In brokerage, my mentor, Bill, for 4 years, he showed me how to buy and sell and really understand the brokerage. In the debt world, Jim. So today, when I find a property, I still go back to that network and have conversations with them. Commercial real estate, in my opinion, is very relationship driven. It's not a one man or one woman show. And I would suggest if you can find people to trust and help you, that will certainly serve you. So what I would just leave you with is, look, if you're serious and you don't have someone right now that you can locally, that you can call on and you trust them and they know who you are and they will look out for your best interest without what I would say ulterior motives, meaning, sometimes going to a broker, they will give you great information, but it's always going to be through the lens of a broker, meaning they want to sell something. I'm not saying that in a negative way. I'm just telling you that you just have to understand the motivations of everyone you're talking to. So I always like to talk to people that don't have what I call a horse in the race, so that I'm getting unbiased information. So if you want unbiased information, certainly you can go to my website, shanemelanson.com. You can set up a 15-minute call with me and we can discuss your investing goals and whether or not it would make sense for me to help you. You could be a passive investor or an active investor. I help, I guess, both types of people. And, if you're looking to raise money, then that's something else that we can have a discussion on. So what I would say is only set this up if you're serious and committed to investing. Just because I've got limited amount of time and I just want to make sure that I'm speaking to people that really want to get into it. So that's it. Hope you enjoyed this kind of 8 non-negotiables, and we'll see you in the next video. Bye for now.